Stanlib has been operational since 1997 and secured retail and institutional mandates in 8 countries outside of South Africa and has over 365 billion rand of assets under management. Joining us in studio to discuss their approach to investing in various asset classes for the local and offshore markets, Paul Hansen, Director of Retail Investments at Stanlib. Welcome, Paul.
Thanks, Erika.
So it's a pretty successful track record over a relatively short period, and with your sights set on Africa, so it gives you a nice regional perspective.
Yes, look, most of our asset allocation has to do with the local asset classes, cash, bonds, listed property, equities, and the offshore asset classes. Africa at the moment doesn't come into our day-to-day, apart from the African team doing their own thing in Africa, buying and selling shares.
Yes.
So we don't include Africa at this stage in our asset allocation.
Paul, if you look at the notion of asset allocation, how many academic research reports have shown us that this is the primary determinant of your returns, your portfolio returns over the long term? So very important to decide between how much to hold in equities, bonds, cash, property, etc. So what's your approach to doing this?
So once a quarter, Stanlib has a meeting amongst all the different fund managers and certain others as well, where we decide, we get the bottom-up approach from the industrials, financials and resource shares, and then we get the top-down from our economist, from our the various heads of the different fixed interest, listed property and equities, and also offshore. And we discuss where should we be here. What do the returns look like for the next 12 to 24 months on each asset class? What do the risks look like? And should we be neutral, overweight or underweight?
I'd imagine these meetings are getting longer and longer and more heated because we're in a low growth world, Chris. So
no, exactly.
Is it about going for equities if you're going to protect yourself against inflation?
Yeah, I mean, look, it's there are very strong opinions on either side or both sides. So that's right, that makes it a lot more interesting now.
My sense though is that the asset allocation procedure is starting to become a little bit more difficult. And my thought is that offshore is particularly difficult because we allocate money according to the capital asset pricing model. Low risk is cash, but there's less return, and there's as you go up the risk chain, more return potential, etc. But the problem is that with what's happening with financial repression on interest rates, etc., where you're not even getting compensated for inflation at what's supposed to be the low risk assets, is that instead of low-risk assets like bonds and cash being your refuge from risk, they're actually becoming the epicenter of risk, with default risk in, for instance, in the case of Greece, for instance, and pretty shortly on the hand like Spain and Italy, where interest rates may come down further, for instance, and you've got the debasement risk on cash. In other words, the investment component on cash, where it's supposed to be retaining value, is being eroded quite a bit.
So is that your feeling? Cash is trash? Yeah,
broadly it is. Because you're actually getting negative returns in a retail money market account. Maybe not an institutional, but retail, you're slipping because of costs are outweighing the income.
Yes.
See, that's the problem. Is
even
that
before inflation.
Exactly. Is that we are starting to get to a position where the actual traditional model for actually managing money to shift between asset classes is in fact breaking down.
Yeah, it's a very unusual setup, and I mean you've had a 31-year bull market in global bonds, or certainly in the developed markets, with the US in the lead there, and this has confounded any and every forecaster that it's gone on for so long. And a year ago we said yields of 2.5–3% were too low. Now it's 1.5% for German and American yields and British yields. So everyone's keeps on saying bonds are too expensive, but they've kept on performing, at least from the government side and some of the corporates. Yeah.
So what are you doing with your balanced portfolios? What's your equity allocation there? Presumably you're still going there, even though there are risks, that's where you're going to get your better return.
We hope so. It's debatable at the moment, but on the balance we prefer equities offshore. So at the moment we very underweight cash and bonds offshore, but with particular reference to government bonds. We do like some of the corporates offshore, but we do prefer the equities on the whole because they're still trading where they were 13 years ago in the developed markets. As far as the local market goes, we're sort of neutral to slightly overweight on local equities. We still overweight local bonds, even though they have had quite a run. neutral listed property, and cash is the balancing factor, probably underweight.
The overweight position on bonds, is that almost a relative story to global bonds, where you see foreign investors might continue to be net buyers, seeing the relative opportunity?
Yeah, it's got a lot to do with that, sure. It does have a lot to do. I mean, look, one has to admit that our bonds have had a huge run, and they may be close to the end. In fact, they're having a little bit of a little bounce in yield here, fall in price. But on the whole, relative to the world, it still looks quite attractive, South African bond.
Yeah. My sense is one of the big constraints with asset allocation is in fact the pools of assets that you can buy, particularly inflation-linked bonds and property, which is such small pools, which really constrains your ability to allocate capital. Property, for instance, has really been something that's been outstanding over the last several years,
yeah.
And but it's such a small component of because of the liquidity constraints.
Yeah.
This is a sense where I think we need to be looking at expanding the actual offering quite a bit.
Yeah, it is too small. What is it, like 3% of the all-share index, the listed property in? Yeah. We've also made use of the global property side. We've got a fund investing in global property, and that has also done very well. And that's an asset class we still prefer to be a little bit overweight there. But for sure, the local listed property is very constrained in terms of its liquidity and size.
So we've seen a lot of corporate action, new listings, etc., mergers and so on of funds, but still
it is growing.
Not enough.
It is growing, and of course it's gone up 30% this year, so it's growing there too. It's gone up 11 times in 10 years if you include the interest in the last 10 years. But it's still not big enough, it's not liquid enough to be able to get in and out for a big account.
Yes. We've got just under a minute, but if I can just ask you, going back to equities, you said on the global market, if you were to allocate there, what's the breakdown between emerging markets and developed markets? Are emerging markets really the solution for you?
Well, you know, certainly they have their issues, but if you look at the Chinese market at a 7-year low, and you look at the Brazilian market, the currency's taken a big knock. You know, Russia often driven by gas and oil, which are picking up here. So, and India's taken a knock too. So we think they're pretty good value. So if your benchmark is about 13% in the all countries world index, we prefer to be a little bit overweight that in emerging markets.